All right, welcome back to the program. In case you're just joining us, it's time for our conversation right now. I'll be talking about the capital market today and perhaps how you should position yourself despite the bearish posture of the capital market or the stock markets. I have David Adu joining me right now. He's a research analyst at Meristem Nigeria. David, good morning to you. How you doing?
Good morning, Nancy.
How you doing and how is
Um,
Lagos?
Lagos is fine. Lagos is fine. Thank you.
Lagos is
How is
fine.
Abuja?
Abuja is cool. Abuja is just there. You know, the weather is quite a bit nice this morning, though we've experienced so much rain at least in the last few weeks. But Abuja is cool and calm. All right, let's get straight to business. Where should I even start
Yeah.
from? Let me allow you talk for a minute. This is your field. Let me give you the floor for just 1 minute. Talk to us about the stock market, what's been happening. Just give us a brief background for someone perhaps that is watching us right now from outside the country, you know, that really does not understand what our capital market is all about. Talk to the person in 1 minute.
Okay. Briefly, the Nigerian equities market, just as we know it, so far this year, even not even from this year, also going back to 2018, the performance of the equities market has been largely bearish. So we've seen a continuous downward trend in the equities market. And when we're trying to dig deeper to even understand what are the factors that are driving this downward trend, we discovered that several reasons. First of all, starting from last year, we've seen that the fears were largely because of it was a pre-election year, and then there were fears regarding the election. Fast forward to 2018, the election was over, and then we also discovered that we also observed that investors were relating to, they were responding to negative sentiments regarding the Nigerian economy as a whole. Um, Company results, most of the sectors in the on the exchange, the results have not really been that fantastic as well. So I mean, all these factors are some of the issues that have been driving what we've been seeing so far in the markets this year.
Isn't it really a sharp turnaround? A sharp turnaround in the sense that the Nigerian stock market was, I think, perhaps the third best performing market, I think in 2017. Or which year was that?
In
Yes,
2017,
yes, in
right?
2017, it posted over 40% return, I think precisely 42%
Yes.
return. And for
Yes.
2018, it wasn't too good. 2019, we're already having a 13% loss. That's year to date loss. Why this sharp curve, you know, in the negative?
Okay, so basically it all boils down back to the sentiment towards the Nigerian economy. We are largely Nigeria's economy is largely responsive or largely driven by oil and the performance in the oil sector. So if you observe, going back to I think from 2018, oil prices started going on a downward trend. When the markets performed very well, oil prices were recovering. But I mean, following that, when the oil prices began the downward trend, we also saw that response by investors in the equities market as well. And then going, like I said earlier, going towards the end of the year, the fears and uncertainty regarding the whole pre-election and how, I mean, the whole policy, macroeconomic and government policy, how that space was likely to behave after, I mean, close to the election year. So those are some of the things that we can attribute to the performance of the equities market over that particular space.
Okay, David, speak to me about how cheap stocks are now. Are they really cheap despite the bearishness? You understand what I mean?
Yeah, I guess you understand what you mean. So, and looking at the entire market as well, when we're trying to look at the trading multiples, that is with Nigeria, when we're comparing Nigeria with other markets, even in Africa and also across the globe, we'll see that Nigeria is actually quite cheap. The PE ratio currently now stands at around 6.93 times. When you compare that to about 15 times in South Africa, 10 times in Egypt, we compare that also to global markets as well, and you see that um, looking at the Nigerian space, it is quite cheap. prices are low. You see most of the large cap stocks, see Dangote, see Nestle, see um, several of the large cap, even Seplat as well. You see that most of them are trading quite low at this particular point in time. So you see that from a pricing perspective, the stocks are quite cheap.
So you're speaking about price to earnings ratio.
Yes,
Okay, so Nigerian stocks are quite cheap right now.
yes, they're quite cheap right now.
Okay, now let's take a look at the earnings. Since we're talking about the price being cheap, the earnings of these companies that are listed on the Nigerian Stock Exchange. So many companies listed on the stock exchange. A few even came in the last few weeks or so. Talk to me about some of these earnings. Is the market satisfied with the earnings return of most of these companies listed on the exchange? That's the A part of the question. The B part is that the earnings, are they categorized according to perhaps the conduciveness, so to speak, of the Nigerian economy? I hope you understand what I mean.
Okay, I'll try to answer.
Okay.
I'll try to answer questions that you asked. So when we're looking at the earnings, it's been sort of a mixed bag or a mixed performance, with some sectors doing at least a little bit better than some. So if we just take a brief look at the consumer goods space, and you can see that except Nestle, most of the consumer goods companies have not really been performing quite well. If you look at say Unilever, if you look at Guinness, I mean look at the brewery sector as well, you see that most of them, their performance have not been really good. The brewery space, since the tariffs came into effect, you can see the impact on both their revenues and also on their bottom lines. Then if you look over at the banking sector, you see that it's quite mixed. Banking sector overall, the sector revenue earnings, they are growing, but when we look at the trend in interest income, basically when you're looking at the interest income, you see that for some of them, interest income has been quite flat. This is because they've not been growing their loan book as much, and then you also look at the yields in the fixed income environment as well. I see that the yields, at least from January to for the first half of the year, yields were on a downtrend. And when you see the impact on their earnings, you will see that the interest income, interest income has been quite, let's say, quite marginal. They supported this with non-interest income, so that line has been doing quite well. And also, if you look at the oil and gas space as well, um, it's been sort of mixed again. Traditional on the exchange, most of the listed companies are the downstream retail downstream guys, and if you look at their own performance as well, you'll see that it has not really been that fantastic this year. You look at several things. You look at in terms of the top line. You see also in terms of the earnings as well. Margins have not been doing quite well, simply because when you look at the whole issues related to the higher landing cost, also the fact that prices are capped, you cannot move prices to adjust for your higher expenses. So you can see the pressure of that on their bottom line. So, when you look at general different sectors of the economy, and then you see different sectors of the companies, and then you see that it's been quite mixed. The major positives are mostly in the banking space, and few names in consumer goods like Nestle. Then also in Nestle, and also in the banking space. Then insurance as well. Just a few names as well in insurance are also doing quite well.
Okay, if you said these companies or this, yes, these sectors are doing quite well, is it uh, perhaps because investors are a lot more interested in those sectors? Or let me also ask the question this way: which sectors are investors
Okay.
mostly interested in right now, despite this bearish posture of the market?
Okay, so in trying to answer that question, traditionally the sector that has usually attracted most interest from foreign investors has been really the banking space and then most of the large cap stocks in the oil and gas. You look at Nestle as well. Most of all those stocks are being held by foreign investors. So, I mean, looking at the performance so far this year, most of the foreign portfolios have already started exiting their positions because of several uncertainties. If you look at the banking space, these uncertainties with the CBN regulations, the new CBN regulations to loan to deposits, and also will I say, get banks to lend. Some of all those have been the factors that have been leading to most of the equity foreign portfolio investors exiting some of their positions so far this year.
Okay, let's take a look at the GDP numbers that were released last week by the National Bureau of Statistics. It did tell us that Nigerian economy is still weakened 1.94% for the second quarter from 2.1% revised in the first quarter. How is the market taking all of this?
Then again, in the
that
market,
sums it up. That sums it up. The exclamation, ha, sums it up.
The overriding factor is just because from the broader perspective, markets, the investors have not really had, I mean, all these factors have contributed to some of the negative sentiments that we've seen. You see the GDP figures that we've seen, that is slower than the Q1, but although it was better than Q2 last year, but still it goes to highlight the fact that the economy is not doing as well as it should be doing. And then when you look at the fact that also population growth and you are looking at GDP growth and you're trying to find how when you're trying to observe that in terms of the productivity, in terms of how much more the economy should grow, it's not growing as much. And this is some of the things that is also contributing to the negative sentiments. You look at the agricultural space slowing, the agricultural sector slowing. You see the manufacturing sector also slowing as well. I mean, these are some of the sectors that would speak to the health of the economy as a whole. But these sectors, when you see that the performance has not really been that good, even in the last quarter, then it also sends a negative signal to the market.
Now, the GDP report that was released last week raises a lot of fundamental concerns. Just like you said, the non-oil sector slowed to 1.64% from 2.47% in the first quarter. We also saw the agricultural sector slowing down from about 3% in the first quarter to 1.7% this in the second quarter. The manufacturing sector also entered into a negative growth. How will all these filter into the marketplace, bearing in mind that there are a lot of companies in different sectors of the market that are listed within these sectors as outlined by the National Bureau of Statistics? Does that mean that some of the companies that are listed within this, that are doing non-oil, that are also into manufacturing, that are also into agri, let's say for example Presco PLC and the likes of them, Okomo Oil Palm, would we begin to see this weakened GDP report filtering into their bottom line perhaps this quarter or towards the end of the year?
Okay, well, for some of the companies, even in this sector, you will have seen that their performance has already started responding earlier, even before the GDP results was already released. The GDP is sort of a lagging indicator of the economy, so it's more or less showing us what has happened, right? So if we are looking going forward, we'll see that the structural issues, some of the challenges that these companies are facing are still there and they've not really been addressed. So when looking at infrastructure issues regarding the road networks, looking at the ports issue, looking at issues around the ports, fine, progress, they're making progress, but until we see a significant change in this, we might still see that their earnings performance might still be pressured. Look at, I mean, when you also look at, just like you rightly mentioned with Presco and Okomo, we've seen how those companies have performed, and you can see that unless some of these challenges are being addressed, we might continue to see the impacts, negative impacts on their own results.
Now let's talk about earnings a little bit, because a lot
Okay.
of companies have been bringing out, of course, is one of the rules that listed companies must undertake. You must quarterly churn out your earnings report. Talk to me about the earnings outlook so far of the Nigerian stock market. I do know that banks, of course, have been bringing out profits, and one would say perhaps how are the banks making so much profit when the economy is also in a very fragile position. Some other companies, even like the agricultural companies that we've just talked about a moment ago, they're also making profits. Some also declare dividends. I think, was it Axis Bank that just declared an interim dividend? A lot of companies, Presco, Triple G, and a lot of companies are paying dividends. Talk to me about the earnings outlook.
Okay. For the earnings outlook, just like you already mentioned, for the banks, one thing that will I say that highlights the resilience of the banking sector is that they always find a way to make money, even when even when the economy is not really doing that well. So banks will always find a way to make money. Right now, yields are going back up. We've seen slight uptick in yields in the fixed income. So we should see that also translates to interest income for banks. I mean, going forward into the year, and we've also seen that several of them they've started intensifying their digital banking activities. So we also see that we also see the effect of that translate to higher fees and commission income for most of them, which should at least provide good buffers for earnings going forward. Then, if we look at some of the other sectors, say we're looking at the consumer goods. Consumer goods is mixed for different companies. So, say for some of them, like for a Nestle, for example, now the outlook is still quite positive because they've been able to, they have a very, very good delivery channel, which has been able to help them to even churn out and maximize. They were able to distribute. They have a very strong delivery network, which has been able to help them, even despite some of these challenges that we've highlighted earlier. So for them, they should still be able to deliver growth in earnings this year. Then when we're looking at, say, the brewery sector, tariffs, the tariffs are what is negatively affecting that space. So higher tariffs on some of their input materials and also some of the final products as is what is really leading to lower earnings, and they've not been able to pass those costs on to customers because it's a very competitive space. So for that, they will continue to some of them will continue to absorb some of the costs, and we'll see that that will negatively impact earnings. We've seen that already for we've seen that for Guinness, we've seen that for Interbrew, we've seen that for Nigerian breweries as well. Then oil and gas sector, we might continue to see, say, margins will definitely be pressured for most of them for some of these reasons that we mentioned earlier.
Let's talk about perhaps the banking sector a bit and how
Okay.
the NPLs, the non-performing loans, how they're rubbing off right now on the banks. I also do know that I think recently a bank that just merged did say that they've made out, I think about 40, they've recovered about 40 billion naira in terms of NPLs. What do you think? How will this affect the banks moving forward? Just opposing it also with the policy by the CBN concerning the LDRs.
Okay. Prior to this time, we saw a downward trend in NPLs to about 9%, if I'm not wrong. 9% in, I think, July, before the last MPC meeting. So, following the macroeconomic issues and the recession challenges that we had in 2016, going down to 2017, when we exited recession, we've seen that the NPLs has also responded in that particular trend. NPL has been on a downward trend. Most of the banks have taken proactive approach. And also with the new accounting regulations that are in place now, the IFRS 9 for the banks that require them to also take a much more proactive approach towards impairment recognition and the like. So that is some of the factors that have contributed to loans NPLs going down. But the challenge now is that with this new NPL, with the new regulation from the CBN that they should, the banks should start giving out loans, maintaining a minimum of 60% from this month. We might see that credits will increase, and once you start giving out more credit, there's always the probability that some percentage of that will go into bad loans. Some percentage of that will go bad. So what we might see is that there will be a slight uptick, but most of the banks they've already started implementing some measures that will ensure that NPLs don't go up or don't tick up as much as it has in the past. And then CBN is also working with them on also developing some frameworks that might ensure that credit management, risk management from the banks is in place so as to prevent uptick in NPL going forward.
Now let's take a look at the IPOs and POs and environment. You know, I know in the past, at least before the market crash, 2008, 2009, we had, you know, so many public offers, so many initial public offerings. What's happening? The space is becoming so dry. Companies, don't they need to access money again from the capital market? What is actually happening? Even the listed, even the companies that came to the stock exchange just a few months ago did not come in the, you know, with the face of a public offering. What's happening? There's no money?
Well, not necessarily. There are several factors that are that we can attribute to this. Number one is that, you know, when you are coming in to do an IPO, you want to be assured that the market is liquid enough such that you can meet your objectives at a right cost. So the thing is that now, since 2018 to now, the market has not been performing very well. And if a company is looking for, say, 100 billion in 100 billion from the rights issue, then when you consider, after you consider the valuation, you will now need to consider how will the market take this. The perception in the market is not really good at the moment. So that means that most of them would need to issue more shares to be able to raise the amount of capital they are looking for. The problem with issuing more shares is that it dilutes your earnings per share, and it dilutes your earnings per share, and you don't really want to have your earnings, your EPS, your shareholders' equity getting diluted. So you want to closely watch that, because that is what eventually affects your value as a firm. So when we look at this, you look at the sentiment in the market. I mean, you want to time the market. Okay, you know what? When the market is in a good place, take for example with MTN. MTN coming into the market, we had expected that they were going to do an IPO, but the problem was that, okay, fine, they still had some issues with the Attorney General of the Federation that will still affect the evaluation. But aside that, when you look at the sentiment in the market at that particular point in time, for them to come to the market to raise capital, they were going to be seriously undervalued. So, I mean, what's the point? Let's just wait till when the market is in a better position, and then we can come and raise the amount of capital we want, and we can be assured that investors will also participate as they should.
Let's take a look at the monetary policy side, which a lot of you, in fact, the capital market always listens to or observes. The next MPC meeting, I think, is if not next week or so, the September meeting, I think. Yes. Is there anything the market is hopeful for?
Okay, from the monetary policy side, going back to I think the second meeting this year when CBN cut rates, we saw that yields started downward decline. Yields started going down, and then the CBN governor was giving the indication that in this second tenure, they are likely to adopt a pro-growth approach, so that bringing down rates, so that cost of funds can be lower, and then the economy, more credit will go to the economy, so that it will grow the economy. But what we are seeing is that yields have started going back up. Homo auctions have started, they've intensified homo auctions just to attract foreign investment and keep our FX rates stable. Our expectation, markets will likely be looking at, is that they might want to keep the macroeconomic space is still a bit fragile, so they might want to keep rates at status quo, such that we don't chase away the foreign investors. Because once we do that, then our exchange rate will come under pressure. Because when you look at all the macroeconomic issues with the country right now, they're not really in a good place. When you're looking at also the issue that the P&ID issue that they're currently settling, we look at oil prices. All these factors all those factors are increasing the risk with Nigeria. So CBN, or the MPC rather, would want to keep rates at an attractive level, such that the portfolio investors would want to at least remain want to remain in the economy. So that's what markets will most likely be looking at going into the next MPC meeting.
Now, how should investors trade this bear market amid this risk? Isn't it? Is there really some kind of upside in this negativity? If there is, how should an investor, how should someone that is coming into the stock market position himself or herself?
That's an interesting question. So, say an investor coming into the market at this particular point in time, you would want to take a more long-term approach, because in the short term, the market is not really doing that well, and we think that it's except we start to see some moves in the fiscal space. Say the minister starts implementing some projects to drive positive sentiment. We might not really see that uptick in the equity space. So what investors will need to do is, coming into the market, you will need to adopt first of all a longer term approach, and then also you want to stick with some stocks with good fundamentals, such that when the market starts to rise, those stocks are some of the stocks that you would see good movement, good price movement on. Also, you want to stick with some stocks that are giving you good dividends at this particular point in time, so that if price is going down, at least you can take comfort from the dividend yield, because that would help to mitigate some of the short-term losses you might see. So you want to also go with some names that have good dividend yields, strong fundamentals, good dividend yield.
Okay, let's talk about the apex regulating body of the capital market, the Securities and Exchange Commission. It's been over the years coming up with reforms and all of that. The e-dividend is also on one hand. I'd like you to explain, perhaps to our viewers, how they should take advantage of the e-dividends, talking about electronic payment right now, and perhaps some of the initiatives of the Securities and Exchange Commission to revitalize the market, giving the market blood tonic to stay afloat, so that the red blood cells of the market doesn't. You're a science student, isn't it? I'm aware you studied, was it chemistry, so you understand what I'm talking about. so that the red blood cells of the market is still, give the market blood tonic, so that it will be okay.
Okay, looking at it from the e-dividend side, we've seen the SEC, we've seen a movement from the normal, the paper-based dividend warrants. We move from that towards the e-dividend, such that you can fill your e-mandate form and then drop it, present that to your bank, and then credit, your dividends will be credited directly to you. So one thing that we've seen is that several amounts of dividends remained unclaimed, and this is not really good, because it also speaks to investor education how familiar are investors with what some of the policies, some of the mechanisms of the market. And we've also seen that most of the stockbrokers, the brokers, have also adopted online platforms such that you no longer need to make phone calls and do all those. You no longer need to send mails. You can trade directly from your devices and purchase stocks on the go. I mean,
Okay.
all these initiatives are sort of driving investor performance and driving investor participation in the market, such that
Okay.
we'll have the red blood cells that we need.
You understand what I mean, isn't it? So let Security and
Yes.
Exchange continue to give the market blood tonic, and let's see if it will definitely make a cut before the end of the year. But I doubt, except something drastic happens within the economy. But many thanks, David, for joining me on today's show.
Yeah.
Thank you.
Thanks for having me. Thank you for having me. Yeah.
All right, I've been speaking with David Adu, a research analyst at Meristem Nigeria. We've been looking at the capital market space. I hope you've been able to get one or two things out of it. You don't just get money to spend, you get money to save and to invest, and the stock market is one of those platforms where you can invest. Just before